Gives me great pleasure now to bring on board S. Naren, Executive Director, CIO with ICICI Prudential AMC, and I've been told that Naren has secretly made a resolution this year that he will start coming to ET Now studio, not join us on Zoom call. Today being an exception, but for rest of the year, that is the resolution. Am I right, Naren? The journalist in me is
Yeah,
curious to know.
definitely. We are not in a COVID world. Why not? Actually,
I like that resolution, Naren. Then let's stick to it. Let's not break this resolution. The problem with the resolutions is that we break a lot. So either you come to ET Now office or I'll be there. We have to meet
sure,
in person.
definitely,
Okay.
definitely.
Now that we've got the most important part, the resolutions out of the way, let's understand markets. Then we are
Sure.
starting the year 2023 with a very different environment. 2022 when we started, I'm going to just expand this question for the benefit of our viewers. The assumptions were interest rates will go higher. The assumptions were that tech had reached a Humpty Dumpty level, it would crack. And the assumptions were that it would be a tough year for world in general, 2022. So some of those assumptions have turned out true. It's only the pace and the impact of geopolitical war which has challenged 2022. So what are the key assumptions for 2023 on the macro front, on the earnings front, and also on the valuation front?
I think 2022 was a year SIP triumphed FIIs, and I think clearly no one would have predicted that SIP can easily triumph FIIs so well. And 2023 will be a year, I guess, debt will be a great asset class, and I believe that it's a very because for the last 3 years, from the time COVID happened and interest rates were brought down in India to very low levels, for 3 years almost, debt was an uninteresting asset class. 2023 will be a year where debt becomes an interesting asset class for many investors, and so that'll be I think 2023 will be the year where people will consider debt as a part of their portfolios, because for the last 3 years they were getting very subpar returns in debt, and that is going to change in 2023, and that will be the big change in my opinion from a domestic investor point of view. Otherwise, we are in a period where valuations of India are completely out of tune with the world, because India is a great structural story. And whether you look at the structural story or you look at the valuations, that is the debate, which is very difficult from a investor point of view for anyone outside the country and for anyone inside the country as well, because no one knows whether which of the two will triumph, whether the valuations being high will create the problem or whether the structural story will actually work in favor. And that becomes a problem because one of them only can work over 2023. If you take a 5 year horizon, structural story will work, but in the shorter term, only one of them can work. And that is the challenge, actually.
Then, if China opens up, and we are talking about a country which has a billion plus population, which has gone through a stop and a start kind of an COVID lockdown period, looks like they will open the economy decisively. When India opened after 3 months of a lockdown, there was a binge in spending, revenge travel, big consumer comeback, spending like never before. I wonder if China comes back in totality in 2023, what will it do to metal demand, energy prices, and again inflation, which we think will peak out, but China comeback could challenge it.
See, it's not like, at all points of time in the cycle, people believe that every cycle will be the same. There's no need for China to keep investing the way they invested in the 2002 to 8 cycle. You can have a different cycle. So clearly, you're going to have consumption demand boom. There's no doubt about it. The population has peaked. So why should they keep constructing houses the way they were constructing houses in the earlier periods? So I think they need to soft land the real estate cycle. And that is what somehow the government will do. After all, it's a centrally planned economy. So I think always we tend to think that each cycle will be the same. cycle in China, even if it were to reopen, would be a different cycle. Clearly, obviously, you're going to have Chinese tourists go out of the country in a much bigger way than what they did in the last 3 years. And you will have a consumption boom much bigger than what you had over the last 3 years. But you don't need to have a Chinese, real estate boom on the lines that you had in the last decade, because you simply don't have population growth like what you had in the 2000 to 2010 period. So that's where I think there will be a difference. And geopolitically, also, things are very different from 2000 to 2010. The rest of the world and China want to embark on a different technology boom, and each of them want to protect their own technologies. So that is also something which will be different in between 2000 and 2010, and what we are going to see at this point of time. So you will have parallel technology progress in both the continents, and that will also be different. So I think it is going to be interesting. Having said that, will we have more inflation due to China reopening? Certainly, but in what products? Did China actually create a big petroleum reserve in this year in 2022? Because their demand went down or not, no one knows, because it's not a country which is transparent like US, where the petroleum reserve has become much smaller due to release. We don't know whether China built a petroleum reserve in 2022. That's not something we will know about. So I think it's going to be interesting. Having said that, will India have to compete with China for emerging market money? In some cases, yes. In some cases, no, because India is unique in its own way. And if emerging market gets money, both China and India will benefit. And we tend to think that dollar is peak. Look at the way yen is rallying now against dollars. I think the dollar peak is very much done somewhere in 2022, October, November. And that I don't think is a problem for 2023.
So Naren, a style which you represent, value, in Hindi terminology, Sasta Sundar Tikau, made a comeback in 2022. Whether it was power utilities, do you think that we are in for a 2-3 year of a market style where value will trump growth?
Basically, this debate we get asked periodically, but the fact is, over 18 years, value is deliver, and there will be periods of time like 2017, 18, 2006, 7, 8, where value failed, and you will have these kind of things. What is value is something which will keep changing. So, for example, right now, pharma looks value. If you look at the last 7 years, almost all but 2 years, pharma has done worse compared to the benchmark. So, what is value will keep changing. And so, you will see that power possibly still has a very good cycle. And maybe power will still be value, but pharma would certainly constitute value at this point of time. So clearly, many of the mid caps and small caps, despite the fact that the mid cap and small cap indices have not done that well, many of the mid cap and small caps constitute exactly the opposite of value at this point of time, because many of the small cap and mid cap stocks are today trading at price to books which are extremely high. So they don't constitute value. So I believe that at different points of time, different things will constitute value, and you will find that those kind of benefits you will still have. For example, we have still been believers in upstream oil as a sector. Although we moderated our call on metals, we never moderated our call on upstream oil because they were all very cheap sectors. And despite various reasons, we found a sector reasonably cheap because oil is a consumption item, metal is a capex item, and it's not dependent on whether China creates a capex story or not. So we had these kind of views. So we believe that value as a theme has will not go out of fashion for the next 20 years or 30 years as well. What is value will change at various points of time.
Hi, morning. I've caught you saying the word consumption quite a bit, and you believe that the next decade belongs to the entire consumption sector. So let's discuss that a little further in greater detail. If one is looking at investing in the sector structurally over the next few years, how do you believe they should be playing this theme?
See, look at a sector like two-wheeler, for example. The volumes today are much, much lower than what it used to be 5, 6 years back. And that is because many of the two-wheeler consumption product prices also went up substantially because of regulations like BS and various other ways. So I believe at some point of time, two-wheeler is a basic product whose volumes have to go up. So if you look at the two-wheeler industry, at some point of time, you're going to see consumption pick up in that sector. Healthcare as a sector is a secular trend for the next 10 years, 20 years, 30 years. So that is another trend. You can't have healthcare underperform for a sustained period of time because India is underpenetrated in healthcare in a very big way. So it can't have a situation where for the next 10 years, 20 years, 30 years, it can underpenetrate. Whereas many of the discretionary categories are trading at valuations which imply that you're going to have sustained growth for the next 20, 30, 20 years at very high rates of growth. So you've got to see some clear moderation when you look at it from a value style, from a growth style. Of course, many of these stocks may still look very attractive, but from a value style, you'll find that some of these stocks are not attractive at this point of time. So I believe that, having said that, India consumption, India infrastructure, India as a space also is not something which can be said to be anything which is unattractive with a decade view, because India is one of the few growth stories over the next one decade, and that is something everyone accepts at this point of time. But it is not growth at reasonable price at this point of time. It is growth at a not cheap price at this point of time. So if at some point of time the valuations were to correct, it would become extremely interesting to go extremely overweight equity in India, because a structural story available at a reasonable price will become a extremely attractive story.
I just wanted to understand from you what the outlook is for the next year, because I believe one of the main themes is multi-asset investing. Can you elaborate a little bit more?
See, basically, in 2020, after COVID and till now, debt was not attractive. Our view has been that, in a year where we expect that at some point of time, Fed will stop hiking, gold, silver becomes interesting. Although, gold, silver did move up already a lot in the last 3 months. 3 months back, we felt silver had a role, but I never expected that silver will move up 25% in such a short span of time. So you have a situation where REITs and InvITs will also become interesting. Gold, silver is also becoming interesting, although the move has been very fast in the recent past. So debt is very interesting. Equity is a great structural story, albeit not cheap. So what we felt was all asset classes at this point of time look attractive. Some not cheap, some very attractive in the near term. So we felt that a multi-asset approach at this point of time is very interesting for investors, rather than a situation like 2020 second half where equity itself was the best asset class, and that was not interesting, and that led us to look for new fund offers, whether it was a business cycle, ESG, or flexi cap at that point of time. Today, we are in a situation where all the asset classes look interesting, and at the same time, we felt that this is a time for safe investing, which is SIPs, systematic investment plans, asset allocation, fixed income, and some amount of parking in categories like equity arbitrage to protect yourself against any big market fall due to any global reason or any reason which we are not able to predict, which can be used to invest in an aggressive asset class like equity. This is how we look at the market at this point of time. So we look at multiple asset classes at this point of time. At the same time, we are recommending safe investing at this point of time, and look for an attractive opportunity at some point of time to invest aggressively in a long-term asset class like equity.
Naren, also wanted your take regarding in 2022. One of the big themes that really came out was, the comeback in terms of manufacturing, defense, industrials. That was the theme really to play out in 2022. Do you expect it will continue in 2023 as well? And is there a specific pocket which is likely to do better than the rest?
Clearly, some of those themes played out very well, and some of them we were positive in some of our funds. Although some of those stocks are not that liquid to play in large funds. We do think those outlook looks good, but the valuations are not as attractive as if you look at sectors like healthcare, or for that matter, today investing in a systematic way in export oriented themes during 2023 look attractive, because at the end of the day, people are so committed to a recession story in the developed world that a systematic investment plan in those kind of areas which are geared towards exports is likely to do well, because people are so negative on the developed world over 2023. So, and as it is, as you know, healthcare and technology were the two worst performing sectors of 2022, and infrastructure was actually the best performing sector of 2022. And so we believe that an export oriented systematic investment over the course of 2023, when people fear a developed world recession, may be a way to invest into a problem. And that we have always seen works very well in investing.
Alluded to it very briefly, the fact that how small caps and mid caps have underperformed in 2022. But could you talk to us a bit more about that? Because in your funds, large part of your holdings are large caps itself, right? Is there a case to be made with respect to tilting your portfolio in 2023 more towards, let's say, the mid cap and small cap?
Actually, small and mid caps are paradoxical. There are many stocks which are extremely overvalued in small and mid caps at this point of time. And that is the reason many of the funds have done very well, despite the indices doing extremely badly. On the other hand, there are many cheap small and mid caps, which I think over the course of the next 2 years may be attractive for investment. So it is not a homogeneous space, where all the stocks have done badly. In fact, there are at this point of time, some of the costliest spaces are not in large caps. The costliest spaces are in small and mid caps at this point of time. You'll be surprised to note there are so many price to book stocks above 7, 8, 9, 10 in small and mid caps at this point of time. So the costliest spaces are in small and mid caps. At the same time, if you look at it over the next 2 years, there may be very attractive opportunities in small and mid caps because of the lack of homogeneity in performance. And there have been many areas where stocks have just collapsed, and where there may be opportunities as the sectors do badly. You might get opportunities, but currently there are a lot of overvalued small and mid caps at this point of time. And one has to be, if one is a direct equity investor, one has to be very careful in choosing the small and mid caps, because there are many stocks which can easily fall 20, 30, 40%. Just like you had 1 year back, people were very, very focused on these few new age companies which got listed, and people were thinking they were all possible big opportunities. And today, as we speak, many of them have become they are no longer darlings of the market. Today there are risks today which abound in some of the small and mid cap stocks in the market. Not all, again, just like the new age companies, these are all some of them, and one has to be very careful. So I tell any investor, when they are looking at, just look at the price to earnings of the stock on a trailing basis. Look at the trailing price to book of the stock that you're buying. Once you look at the trailing price to earnings of the stock and trailing price to book of the stock that you're buying, you will find that what is implied in the stock, and you will find that there are many overvalued stocks at this point of time in small and mid cap, which people are not recognizing. Just like 1 year back, people didn't recognize that in many of the new age companies, they were buying loss-making companies at inflated valuations, and now that entire pack has actually corrected more than 50% in the last 1 year. It would be now the time for some of the costlier small and mid caps to correct over the course of the next 1 year or 2 years or 3 years. No one can predict timing actually.
All right. Thanks very much then, Naren, for sharing with us your views, key themes, as well as outlook for 2023. Good having you on ET Now.
Thank you. Wish everyone a happy 2023.
To you too and the entire team.